Hello and welcome to BQ Prime. A very good afternoon to all the viewers. I'm Hiral Dadia. One stock that is in focus is a Quess Corp on the back of the first quarter numbers that have been reported. Clearly, the revenues have been pretty much as per what the street was estimating. However, there is a miss as compared to the profitability end. Let's understand more in terms of how the quarter has been and what's the strategy going ahead. Joining us on the show is Mr. Guruprasad Srinivasan, ED and Group CEO, as well as we have Mr. Kamal Hoda, Group CFO at Quess Corp, joining in. Welcome to the show, gentlemen, and a pleasure to speak to you as always.
Thanks, Hiral. Thanks for having us on the show.
My first question coming to you is overall, has the quarter met your internal expectations? And if yes, which have been the key drivers and which have been the factors, that have not really worked well?
Sure. First and foremost, our Q1 has been to the plan, to the AOP plan very clearly, and we are quite happy the way the results have been announced. Key call out is our global technology platform, which has crossed an 100 crore mark of EBITDA contribution on a quarterly basis. So that's a big call out for us. And it's also a kind of platform which delivers the highest EBITDA margin for us. And it also reinforces our all-weather investment thesis in terms of good EBITDA margin coming out from this particular platform. And the second call out is, despite of the market conditions, we have been able to add about 14,000 plus headcount in Q1, of which our workforce management general staffing contributes about 13,000 headcount. And overall at a 16% growth year on year in terms of our revenue. Our third platform, which is OAM, has been steady state in terms of its delivery and the contribution back into our revenues. So with all these three large platforms being steady state and product led, putting more effort on candidate engagement and better and more success on more job posting coming onto the platform, overall we are in a great shape to start the year.
Right. So those are the key highlights that we are watching out for in terms of the quarter. One of the factors we would want to consider is in terms of the margin. There has been a slight compression in terms of margins. What has led to this, and where do you see it stabilizing in FY24?
So one key contribution there comes from in terms of margin drop is a couple of investments that we have made. One is, of course, the product-led business in itself. We have been calling out. It's in an investment phase. We are spending on marketing activities. We are spending more on candidate acquisition. So that is a place where we have done some investments starting from Q4 of last year. And the other two callouts last year, Q1. We had higher contribution coming from our selection business, which is also a high margin business where we do hiring specifically for IT segment when IT hiring was at its peak in Q1, which is not the case in Q1 FY24. That has impacted a bit onto our workforce platform margins, plus investment in North America that we have made for our professional staffing. There are slight cost increase that has happened in Q1 this year due to the annual, term benefits that we have to pay in terms of insurance and other costs, which is in Q1. So it should start getting better in Q2. So in nutshell, investment in product-led business plus contribution almost 73% down in terms of our selection business compared to last quarter. Plus added to that our North America burning a bit more than expected. These are three contributors of which, if you look at product-led business, we have clearly called out that FY24, they should start reducing the losses by Q4. We should be in a better shape as we move forward in this quarter.
Right. So that's with regards to where the margin profile overall goes. Now let's look at the various verticals. From workforce management to global technology solutions to operating asset management and product-led business. Workforce management and product-led business are the ones where the contribution has been lower in terms of the EBITDA, right? Now, which segments are expected to be growth drivers going ahead, and which segments do you continue to see pressure points?
So I'll kickstart and then get Kamal to loop into. As I said, GTS is definitely the front runner for us, contributing 21% plus in terms of their growth. If you look at phenomenal milestone that they have crossed, crossing 100 crore contribution in terms to our EBITDA at an 18% healthy margin. So they would still, we see a lot of potential coming in from our customer lifecycle management business, IT, non-voice BPO and also payroll and international CLM business that we do. There we definitely we are seeing a lot of traction coming into. We have increased the number of seats in our delivery in Manila. We have won more international customers in terms of new orders that we have got. So we are seeing a lot of traction coming in from GTS. Followed by definitely, workforce will continue to be our way to focus for coming next upcoming 3 quarters because season is just around the corner for staffing business. We are seeing more demand coming in from manufacturing and BFSI segments for Q2. So that's an area for us to watch. And of course, as part of the integrated asset maintenance business, our focus is going to be to keep it a steady state and focus on more deeper reviews and growth of that business.
Right.
In
Yes.
addition to what we said, if I may add, two sectors which are, very critical for us in terms of our margin uplift. One is Founded, wherein we have called out earlier that we want to exit Q4 of this financial year at a break even. So right now, product-led business is actually burning around 25-26 crores of EBITDA per quarter. And we see this platform to start reducing its burn starting this quarter onwards and gradually becoming a break-even business by end of this financial year. So that is one area where definitely we will see a margin uptake on an overall consolidated basis. The second one, like Guru explained, is the investments in North America has taken a bit more time than expected in terms of building up the pipeline. But we put North America on a watch out and, we're absolutely focused there, having incurred significant costs in last year in Q1. We expect North America also to, do break even by exit Q2 or early Q3.
Right. In fact, one quick question as a follow-up, Mr. Hoda, I would want to take with you is, as you mentioned about the product-led business, which will start improving from here on. The last 5 quarters, yes, we've seen a downtick, but what's the plan to break even specifically from the North American market perspective as well?
So here are two separate things. I think Founded, in terms of the cost base, we are not seeing any increase. So in terms of the team, product, marketing, we have a fixed cost base now. And it's only the uptake in revenue which should definitely help us in break even. If you see on a year-on-year basis, despite the headwinds in the market, this business has grown 30% on our top line on a year-on-year basis. And with having right set of investments done in the product and now investing further in marketing and database, we expect this business to gradually become break even. As far as North America is concerned, we've already started seeing some positive shoots. We already are working with 8 different customers there. We have 100 plus open mandates position and with a lean cost of delivery from Manila as well as from India. We believe we should be able to break even the North America business also, like I said, by exit of Q2 or early Q3.
Right. So that's with regards to where the product-led business segment goes. From here on, if you could share some light with regards to the domestic as well as the overseas performance, and what will the strategy be going ahead?
So we'll have, of course, our strategy will be at a platform level. For workforce, of course, India continues to be the large focus. And within India, if I were to look at general staffing, contributes to 50% of the platform's EBITDA. So our focus is definitely in that segment. The upcoming sectors are quite promising for us. So manufacturing is an area that we are seeing a lot of traction happening. We have, as Quess general staffing, we have crossed 50,000 deployment of our headcount specifically in manufacturing segment, and almost about 100. We have crossed about 100,000 in BFSI. So our strategy is definitely going to be at a segment level. and specifically. And when it comes to GTS, of course, we'll have strategy for both international and domestic because we operate in both the place. I mean, if you look at both are growing simultaneously at the same higher double digit growths that we are able to command. We will have probably a much deeper target and deeper, much more steeper push in our OEM business, which has to accelerate more because this business got a little stuck with COVID and post-COVID, slowdown in terms of coming out of the COVID and getting back to the normalcy of return back to work. Our strategy there is how do we penetrate deeper into other segments to de-risk from ITES kind of segment. So that is where our strategy is going to be very different in terms of deepening our sales ability, pushing through more of comprehensive propositions. So by platform, of course, our strategy is going to be very specific as to how we want to drive them. But all of this, sum total of all of this is going to be aiming towards the commitments that we have made, whether it is how do we drive our overall ROE towards 20% as we committed. That's a direction that we are working on. How do we better year by year, and in next 2 years can we reach there? So that is the kind of drive that we are having internally.
Right. Overall, from a revenue concentration perspective, above 50% on average comes in from the top 10 customers across segments, right? Now, is the business comfortable with that, or are there plans to go ahead and diversify from a client addition perspective?
So, as where we are, definitely it is comfortable because it gives you the market share. It allows you to invest more onto such customers, right? So, for example, any new initiatives that we want to do, whether it is productivity drive with our customers, it makes sense for us to work much closer and understand our customer needs better. I mean, today, if you look at, we engage much prior in terms of what needs to be done with our customer, whether it is hiring, whether it is onboarding, or we sync to their season and their sales, their product promotion and etc. in much advance. So from that perspective, it creates more integral kind of bonding between us and customers. So we are definitely having that, enjoying that as one of the key benefits while having the constant customer concentration. At the same time, if you look at number of logos that we are signing, even that is pretty healthy. Every quarter we are signing upward of about 150 plus contracts across Quess. So, while we will grow more with existing customers, there's also a long list that is getting added quarter after quarter. It's a combination of both.
And overall, apart from this, in the business that the company is in is slightly kind of cyclical, right? I mean, you have margins fluctuating across quarters. So what is the strategy going to be actually to insulate the business from the seasonal losses that we see?
So, very good question. And across Quess, if you look at, we are quite well placed between three platforms. So when there is a slowdown in workforce, our GTS and OEM tends to do well, and overall it supports us in our quality of revenue or margin that it can sustain into. So that's specifically what we call it as an all-weather business. Now, coming back to if I were to little get into the segment specific, so if there were to be a seasonal cycling, for example, in between Q4 to Q1, we see FMCG coming down, and slowly the other segment, BFSI and manufacturing and telecom, taking up that space. And whereas when we step into Q2, FMCG, FMCD, and the retail would start coming into action. So in a way, it helps us to keep our hiring engine intact in terms of how do we offload and onload people onto the newer projects or the peak coming into. In fact, that's one of the key deliverable within the system. We are one of the, I would proudly say that we are one of the best at in terms of managing the entire cyclical thing. The other impact that it can bring in is slight change to our core to associate ratio. So if you look at Q4, we would be high on our core to associate ratio, slowly tapering down, because as season comes up, we hire more recruiters, we hire more sales and execution people. our core to associates slightly comes down, but again, it will recoup back in Q3 and Q4. So that's the nature of the business, and that's how it is. But overall, we look at how much net in addition that we do quarter on quarter. So in a way, this is a cyclic business, and we are mindful about it is a cyclic business, and it has to be. That's a key of handling the cyclicity along with our customers.
Mr. Hoda, coming to you in terms of the ROE, in FY23 we were at around 9.19%. The plan is to get to 20% in FY25, right? So what's going to the strategy be to get to that double-digit number?
Yeah, Hiral, thanks for this question. So we want to do it in 2 steps. We want to move from the present level of 8.9% to, let's say, 12 to 13% levels by the end of this financial year. Take it to 15-16% by the year subsequent to that, and then hit 20% in FY25. Now there are 3 or 4 critical steps for us to achieve that. First and foremost, the investments that we have done both in product-led business, North America, in the gig platform, all these investments have to pay back returns in terms of the ROI that was expected when these businesses were invested upon. And from that perspective, the current year is a very crucial year for us because we are anticipating a good upside from these platforms as well as break-evens for the respective platforms in this financial year. So that gives us enough confidence that we are on that trajectory of the aspiration 20% ROE that we have given. And this year would probably help us, guide the market again that we have delivered a better ROE from last year. This is contribution from these investment businesses.
Okay. And in terms of, Mr. Hoda, the target of 33% return on the FCF to shareholders, will that bode well with the company's growth plans, or is there a possibility that it could create some bit of stress on the reserves down the line?
No, Hiral, that was a stated policy that we put in 3 years back, and in last 3 years, despite doing significant investments in these platforms that I just explained, happy to share that we've actually done exactly 33% over last 3 years. We continue to be guided by the same policy, and we are confident that we'll be able to continue this policy in the upcoming years as well.
Okay. And my last question coming in is overall, from a key milestone perspective from here on, what is it that we are looking at in terms of growth, number one? And number two, any impact with the kind of slowdown that we are seeing in terms of international markets?
So, generally we don't give the forward-looking guidance on this, but if you look at the historic delivery, we have been upward of 16, year on year 16%, as per the Q1, but anywhere between 16 to 20% is definitely achievable. Coming back to the other question in terms of are we seeing any slowdown? At the moment, no, not really. But specific to IT staffing, we still have a call out. IT services are still not completely back in their rigor in terms of hiring. So we are seeing a slowness coming in, which is also impacting, which has impacted on our selection business. Specific to any international, our exposure to international business, if you look at, is largely in workforce and international customer lifecycle management. CLM side, I'm not seeing any slowdown. Whereas when it comes to professional staffing, there is some slowness in terms of hiring in Singapore and Middle East. So that is it's a wait and watch for us. But overall, we are still confident the kind of growth that we are anticipating and the demand which is coming in. We are still confident to see that we can grow 20%.
Right. So that's what the street will be watching out for as well. So that's the management of Quess Corp. Thank you, Mr. Srinivasan. Thank you, Mr. Hoda, for joining us on the show and having this candid conversation with us for the benefit of the investors and the viewers. That's all that we have on this session. Thanks for watching, and lots more lined up during the course of the day. Please stay tuned to BQ Prime.